Good afternoon, everybody. My name is George Joyner. I'm with Putnam Score, and I'll be your host today. And it's my pleasure to, be with you and share a great presentation on basic record keeping to keep your business running. And euphemistically, it's go beyond the shoebox. Let's take the next step. Galina, slide. I'm with, as I said, Putnam Score. This presentation is being brought to you by the combined Score chapters in the Hudson Valley and greater New York area. And for those of you that aren't familiar with Score, we're a nationally based not-for-profit. Our goal is to try and grow small businesses through free mentoring and education. And the primary services that we offer are free and confidential one-on-one business mentoring. We also offer webinars and workshops, webinars just like you're going to be listening to now. And we have extensive online educational resources, templates, books, the like on our website, which is www.score.org. We work with businesses from startups to small businesses of 50, 150 people and even more. We're staffed primarily by volunteer business mentors. We have a huge representation of different industries and skill sets spread among 10,000 volunteers across the country. Galina? The chapters that are represented here today are on your screen right now. You don't have to worry about capturing any of the information because we will be sending out a recording of this webinar, including all the slides, to those that have registered, and they'll be going out probably tomorrow morning. So this is not necessary to copy it down, but this is who we are. Lena? Next. Some ground rules on the webinar. Everybody's going to be muted during the presentation, and I ask you to please submit your questions not through the chat box, which will be turned off, but use the Q&A box. We'll try and answer as many questions as we can at the end of the presentation. If there are any left over, or you have questions that occur to you after the presentation, you will have Galina's contact information, and you'll be able to send her an email or contact her with the question or more information, whatever it is you needed. So with that, I'd like to, next one is, I'd like to start our webinar. It's going to be a webinar that's going to deal with a lot of the questions that you really need to answer in running a business. So is your business making money? Are you profitable? How profitable? And we're going to look at the topics that you see here, and Galina will be going into each of those in more depth. Our presenter today is Galina Pissamena. She's a certified CPA, and she owns a Hudson Valley-based accounting firm called Your Online Bookkeeping. She helps small businesses organize their bookkeeping records, understand the financial health of their business, work with them on taxes, and just all the services that you need to keep your books and business running smoothly. She has a master's in accounting, and she's been an accounting professional since 2008. And with that, I will disappear and turn the microphone over to Galina. And welcome, Galina, and thank you for joining us.
Thank you, George. I appreciate the introduction. Thank you, everybody, for tuning in to our webinar called Basic Record Keeping to Keep Your Business Running, Beyond the Shoebox. George did a very nice introduction, but let me introduce myself as well. My name is Galina Pissamena. I'm a CPA, and I'm the owner of the Hudson Valley-based accounting firm, Your Online Bookkeeping, or GP Accounting and Tax Services, LLC. We go under both names. And as George mentioned, I help small businesses to organize their finances, understand the financial health of their business, and prepare them for the tax season. Let me tell you right away, the topic isn't the one that keeps you on the edge of your seat. Nobody goes into the business because they want to deal with bookkeeping and tax compliance, except accountants, of course. Well, have you heard the joke about a fun accountant? No, you didn't? Well, me neither. So let's get started. But before we get started, I would like a poll question to be pulled to the screen. And if you could answer that poll question, that would be great. We'll give you about 30 seconds, and then we will continue. Oh, okay, great. Wonderful. So we have 15% of people said that they don't keep their books right now, 71% keeping them by themselves, 3% has the employee, 2% family member, and 9% a professional bookkeeper. And how often do you work with the CPA? 9% on a monthly basis, 57% for taxes only, and never is 34%. Okay, great. Thank you so much. I appreciate all the answers. That actually helps me to know who is the audience today and where to spend a little bit more time. So let's dive in. So our agenda for today is going to be, we're going to talk about the bookkeeping, record keeping, and why do you need it? Always start with the why, right? We'll answer the question of what do you need to track? We'll talk about the profit and loss statements, balance sheet statement, and the statement of cash flow. That is always often overlooked. Then we'll discuss some of the basic financial ratios and what they tell you about your business. We'll go over some of the tax saving opportunities, or we'll discuss how bookkeeping affects your taxes. We will touch a little bit on budgeting and forecasting. That is the service that not all bookkeepers provide. Sometimes you need to hire an additional professional, like a financial planner, so to say, for your business to do the budgeting and forecasting, but we will touch on what it is. So let's get started. What is bookkeeping and record keeping, and why do you need it? So the answer is easy and difficult, but there are two main reasons why do you need to know your books and to have your bookkeeping in order. You needed to understand and know your business, and you needed to protect your business. So just like on a picture, what you do in your business is just the tip of everything that needs to get done, but there is a lot of work that is going on behind the scenes. Today, we're going to concentrate on record keeping and bookkeeping and how knowing your books will help you grow and protect your business. So, record keeping is an act of keeping track of history of persons and organizational activities. And bookkeeping is an accounting skill of keeping records of financial activities. So as you can tell, both terms are very similar. They're often used interchangeably, even though they're not the same. I noticed that usually when IRS talks about bookkeeping, they actually refer to it as a record keeping. But when you talk to an accounting professional, they will refer to it as bookkeeping. How knowing your books can help you grow your business? There are a couple of ways. Wouldn't it be amazing if you could know exactly where your business stands, how much money you make on each sale and client, and what are the areas of improvements? This is what bookkeeping is about. When you have clean books, you're able to run an analysis of the financial health of your business, which gives you an opportunity to react proactively to adverse events, grow steadily, and make good business decisions. I had a client who came to me and said, I'm doing great. My business is bringing over 100,000 each in cash each year. It's amazing. When we started looking into his financial statements, he actually had a loss because he was completely in debt, even though at that point in time, he had cash in his bank account. It would take him about 10 years of not taking any distributions out of his business to pay the loan back with the trajectory of sales that he was having. Once he understood his numbers, he was able to make necessary adjustments, like cutting back on unnecessary expenses, increasing his price slightly, and negotiating his future contracts more carefully to take advantage of the debt that he had and not end up with a failing business and a loan to repay. How knowing your books can help you protect your business. There are a couple of very important things that you can do to protect your business. Tax compliance, check on your bookkeeper, and be generally informed about what is going on in your business. With the tax compliance, per the IRS guidelines, every business should have a good record of their financial activity. It is not a nice to have, it's a must have. Every deduction on your tax return needs to be supported by the appropriate financial record, and that includes receipts. Otherwise, you might face fines and additional taxes. Many of you might rely on accountants and professionals to take care of your needs, but the truth is you are responsible. I always like to say there are 3 types of accountants: those that can count and those that can't. I had clients who came to me with IRS letters because their tax return preparers took $5,000 charitable deduction to make their tax return look good. They thought that their tax accountant was extremely smart for doing that. But eventually they were the ones who were audited by the IRS, and they were the ones who had to deal with the IRS and repay all the fines and taxes back because they didn't have the financial records to substantiate the claim for the deduction. Always ask questions. When something doesn't look right, then it probably isn't. When you know your business well, it is much easier to spot any irregularities. And I would like to emphasize that if you are ever audited by the tax authority, it can be state authority or it can be the IRS, right, a federal authority, they will ask you for financial records and especially for receipts. Keep all the receipts. Talk to your bookkeeper if you have one, and make sure that one of you has a responsibility of attaching receipts or storing the receipts. And that brings me to the second point of checking on your bookkeeper. That's right. As I say to all my clients, don't blindly trust your finance staff. Run the numbers. It isn't as hard as it seems. We want to believe that other professionals are honest, but let's be real, things happen. I've heard of numerous examples of bookkeepers writing checks to their own names and writing off expenses as supplies, accepting cash payments and never depositing them, simply closing the account and writing off the balance as miscellaneous expense. I personally worked with a person who embezzled funds from the company that both of us worked for. The motivation is not always evil. It can be a sick relative, a sick child, but often it's simply lack of controls. You are essentially the most vested person in your business. This is your baby. You care about it, and you're the main person to care for it. So what do you need to track? There are a couple of things that are important in your tracking system: income and expenses, assets and liabilities. All business income needs to be tracked, even the one you received in the form of cash on hand. The expenses that need to be tracked usually depend on the nature of your business. If you're a landscaping business, you might have business expenses for vehicles, equipment, protective gear, advertisement. Your expenses for a manicure after work, while might be very much needed, will not be considered a business expense. But if you're a model, and that's how you make your money with your looks, your manicure could be considered a business expense. I overhear business owners sometimes say that they received payment in cash, so they don't need to report it. That's not true. If you received payment in cash, it doesn't mean that the business that you didn't report this payment as an expense on their books or won't report this payment on your behalf. I saw it many times. People don't report cash payments because they think that no one knows about them, then receive a huge tax adjustment because the payment was reported to the IRS on their behalf. I'm mostly talking about 1099s that you need to send out actually shortly to all the vendors, and that some of your clients would need to send out to you. The expenses, depending on the structure of your business, your expenses can be different. For instance, if you're a single member LLC, you wouldn't pay yourself a salary, but you can pay the salary to your employees, other people besides yourself. So your expense would be different. You'll have the owner's draw versus the salary. If you're an S corporation, you can pay salary for yourself. You should pay salary for yourself. So your accountant would be different. But we will not concentrate on that today. So as you see on the screen, the income includes cash, non-cash payments, and barters. If somebody does something for you in exchange for your services, you do need to record it on your books. Expenses, as we mentioned, equipment, but equipment can also be an asset, depending on the situation. Supplies, anything business related, salaries, as we already spoke about that. And assets and liabilities. Like in the example that I showed you earlier, sometimes business owners simply forget that they have debt to repay and make reckless decisions with the money that they make. It's very simple to spend the money, as we all know. It isn't so easy to earn. And when debt is involved, you need to make sure that you are covered. I was just talking to a fellow accountant another day. She said to me that one of her clients was in disbelief that he had a ton of clients, but no cash in his business. It turned out that he sold the product on account, right, on accounts receivable, and simply forgot to collect due to the lack of proper record keeping. It's like giving somebody a gift, right? The financial statements. What are the main financial statements? Profit and loss, balance sheet, statement of cash flow. These three statements are the main statements of your business. And what do? They help you understand your business and know where your money are. Let's dive in. Profit and loss statement is also called income statement or sometimes P&L. As the name suggests, it is a statement of all your income and expenses. It's important to note the difference between the profit, income, and revenue. Definitions can vary on the content, but in general, revenue is all the money that your business received from business activity. Income is what is left after the deduction of expenses. Profit is income that is above zero, contrary to loss, which is below zero. Balance sheet. Oh, and the income statement shows your company revenue and expenses during a particular period of time. It can be months, it can be a quarter, or it can be a year. In 2 years, if you run your financial statements over 2 years. Balance sheet. The short for the balance sheet, the abbreviation for the balance sheet is BS. It's not what you think. It is a balance sheet, and it shows you all your assets, liabilities, and equities. What are your assets? Anything that your business owns, cash, equipment, inventory, receivables that we spoke about earlier. What are your liabilities? Everything that your business is liable for. Your loans, credits, unpaid taxes, and payables to your vendors. Equity. Equity is pretty much your portion of your business. If you have an investment of $10,000 in your business, this money will not be an income of your business. That's your equity. That's what you put into your business. Which brings me to the third statement, which is the statement of cash flow. This statement is very important, but often forgotten. It shows you pretty much where your money went. For example, you might have $10,000 in profit on your P&L. Does that mean that you're in great shape? Not necessarily if you have unpaid balances for purchases in the amount of $20,000. The cash flow, the statement of cash flow will basically take your cash on hand and your profit from the business, from the P&L, and show you why there is a difference. I hope that this is helpful. And we will move on to the next slide. Basic financial ratios and what they tell you. Finally, something a little bit more fun, right? You see what I'm saying when accountants have fun? We love this, but that's the definition of fun for us. And why do you need to know the financial ratios? The financial ratios will show you the health of your business. Is it moving in the right direction? Are you on track with your goals? Are you in trouble? There are a couple of financial statements that we are going to go over today. My apologies, it was actually on the previous slide, but I'm just going to go through them as is. The gross profit ratio or margin is the first one that we are going to talk about. And it tells you how much of your sales is consumed by the cost of goods sold. I'm going to pause here for a second and explain to you what is cost of goods sold, or as accountants call it, COGS. Let's say you are selling buckets and you sold the buckets for $20. You purchased them for $15. The $15 is your cost of goods sold, just as the name suggests. If you're a manufacturer, sometimes the salaries of the employees who work on the product that you are manufacturing can be considered cost of goods sold. But for the purposes of this presentation, I'm going to refer to the cost of goods sold as only the product that you purchased for resale, and the rest of the expenses are going to be called other expenses or administrative expenses. Let's get back to the gross profit ratio or margin. The gross profit ratio is calculated by taking your sales minus COGS divided by sales. Let's dive in. Let's say the customer paid $50,000 for the product and your cost of goods sold was $30,000. That means that your gross profit ratio is 0.4. That means that you're making 40 cents on every $1 you sell before your non-COGS or other administrative expenses. So you're making 40%. That's not bad at all. Net profit ratio. How much income you put into your pocket. Net profit ratio is calculated almost like gross profit ratio. The difference is that you take the COGS or cost of goods sold expenses and you add to them all the other expenses. So sales, if you have customers paid you $50,000 for the product, your cost of goods sold is $30,000. Expenses are the expenses of $10,000. When you make the calculation, it comes out to 0.2. What does that mean? That means that you're making 20 cents on every $1 that you sell. or you make 20%. Also not bad, right? The next ratio is the one that everybody's really interested in. And at the same time, I find that many people are a little bit intimidated by it, but there's really nothing intimidating. The return on investment, or ROI, tells you how much money did your investment make for you. And it's calculated by sales minus investment divided by the investment. If the other two ratios, we divide it by the sales, in this case, we divide by investment. That's pretty much the only difference. It's just a little bit other way to look at your statements or at your income. So let's say if the customer paid you $50,000 and your investment was $30,000, your return on investment is 0.67. You made 67 cents on every $1 that you invested. That's your return. So this slide shows you the difference between the three ratios, the comparison. So as you can tell, all the ratios are taken from pretty much the same numbers. These are just different ways to look at the same numbers. Next, I would like to talk about some of the ratios that are not as popular as these profit and loss ratios, but they relate to your balance sheet. They're extremely important. Receivables turnover ratio, just like we spoke about accounts receivables before, right? The receivables turnover ratio will show you how fast do you turn a promise to pay into an actual payment. And it's calculated by taking the net credit sales and dividing them by average accounts receivable. Why it's important? Because if you show 100,000 as income on your P&L, it will become a loss if you don't collect this money, right? So the lower turnover ratio is, the better it is for your business, and the higher turnover ratio is, the worse it is for your business. Asset ratio, or sometimes it's called the current asset ratio. It answers the question, can my assets cover my liabilities today? And it's calculated by current assets divided by current liabilities. It's best if your asset ratio is more than 1, and it's not as good if it's less than 1. Debt ratio is the opposite of the asset ratio. So you take the debt and you divide it by your assets. And it answers the question of, am I in trouble? Do I have more debt than I have assets to cover them? A high debt ratio indicates that a company is highly leveraged or highly in debt. So the lower the ratio, the debt ratio is, the better. With all these ratios, it's extremely important to have all your financial records in order, because as accountants like to say, garbage in, garbage out. And what that means is that if you have wrong numbers that go into these ratios, you will get wrong ratios. And then you will make the wrong decisions because you will not have the correct information on hand to make the informed, correct decisions for your business. We're going to move to the next slide. How bookkeeping affects your taxes. So the burden of proof, this is the first thing that we are going to talk about. And the text on the screen right now is from the IRS guidance. And as you can tell, it says here, you should keep adequate records to prove your expenses or have sufficient evidence that will support your own statement. You generally must have documentary evidence such as receipts, canceled checks, bills to support your expenses. Additional evidence is required for travel and entertainment, gifts, and auto expenses. So as we mentioned before, good record keeping is an IRS and local authorities' requirements. When the IRS questions your income and expenses, it's on you to prove that you have everything in order and everything is correct. Organized books will alleviate the stress and anxiety and might help you fight IRS charges in case of the audit. And how can you save on taxes with good record keeping? When you have good record keeping, you can actually have a very productive conversation with your tax accountant. And there are a couple of ways how you can save on your taxes. First is the accountant basis. In some cases, you can elect to use cash basis of accountant or accrual basis of accountant, which are two main bases of accounting methods. When you calculate your books on accrual basis, you consider your income to be real when you did the work, even if you didn't receive the money yet. And your expenses are considered to be real when you incur them, even if you didn't pay for them yet. Accounting jerk alert. Are you ready for it? It's a cruel world. We're going to move on to the cash accounting. When you calculate your tax on a cash accounting basis, your income and expenses are considered earned when the money are received. Both methods can be very powerful tools when you analyze your profitability. For instance, if you sold 100 Christmas trees at $10 each on December 24th, but your client did not pay you until January 2nd, when they sold those trees, let's say you are a wholesaler, the income might be calculated in the current year when you sold the trees on December 21st on accrual basis. But in the next year on January 2nd, on the cash basis. Depending on the business structure, IRS might require you to file your taxes on certain basis, on a cash basis or accrual basis, even if your record keeping is on a different basis. And sometimes you want it that way because sometimes for the financial analysis, it makes more sense to have your books on a certain basis, let's say on accrual, even if you have to file your taxes on a cash basis. Depreciation of assets. Ooh, another accounting joke. What do accountants suffer from that ordinary people don't? Depreciation. That's right. You might depreciate your business assets over 5 years or over 27 years, depending on the tax rules and regulations. Sometimes you're able to take your assets and depreciate them in full in the current year for the tax purposes to lower your tax liability. When you have your books in order and you have all your depreciation calculated on the books, it's much easier for you and your tax accountant to sit down, go over all the depreciations of your assets and of your books, and make sure that you are taking the tax position that is most beneficial for you in the long run. And then we're going to talk about some of the business deductions that you might not know about. One of them that I'm going to talk about is going to be the home office deduction. If you have a home office that you use solely for business, that is part of your main home, you can write off expenses for that office at tax time. It has to be used 100% for business. I know of the audits when a dog bag would disqualify a taxpayer from claiming home office deduction. So you really need to be careful with that. But if you have a corner in your home, even if you rent a home, sometimes you're able to deduct that portion on your businesses, on your tax return if you have a business and if you use that corner specifically for business. The same goes for your laptop. If you use it 100% for your business, you can deduct it. If you don't use it 100% for your business, that you might be able to deduct it, but only certain amount used for business. Business mileage. If you use your personal vehicles for business expenses, sometimes you can deduct the business mileage. If you have a vehicle that is registered on your business and used 100% for business, then you can write off the expenses for that vehicle on your taxes. Cell phones as well. If you use your cell phone for business, 100%, you write off 100%. If not, then only a portion. Estimated tax payments. Always talk to your accountant about estimated tax payments and always give them the proof that you paid them. I see it all the time. People don't have the records of their estimated tax payments. They think that they paid during the year. As you know, right? You need to pay your taxes quarterly when you have your business. Sometimes people forget that they didn't pay, and they end up with the huge tax bill later on. All right, with that, we're going to move to the next topic in our conversation, which is budgeting and forecasting. With a good record keeping, you are able to plan for the future. What is budgeting? Budgeting lays out the plan for what a business wants to achieve. What is a forecast? Forecast states its actual expectations for results. And both of those are based on the historical data or the financial statements. Because financial statements give an actual picture at a point in time. As I mentioned before, not all bookkeepers and not all accountants would do budgeting and forecasting for you. You do want to talk about it with your bookkeeper or accountant or anybody who takes care of your books right now. Sometimes you might be able to do it on your own with various tools. And we're going to talk about the tools on the next slide. So there are many bookkeeping tools. One of the most popular one is QuickBooks. There is an online version, there is a desktop version. Then, but again, this is not the only software that you can use. There is a software called Xero, FreshBooks, Wave. Wave is actually the one that I believe is free. At least they have a free version of the software. You can use Excel spreadsheet or Google Sheet. If your business is small enough and it's not complicated, there's really not anything else that you need to do other than track your income and expenses in Excel spreadsheet. Or you can just use a bookkeeper who use their own system, and you don't even need to know what system they're using, as long as they are showing to you all the financial statements when you need them, and as long as you have all the receipts, as we mentioned, in case of the audit. Mileage apps. I think I didn't mention when I spoke about the business mileage that in order to keep the business mileage, you need to take the odometer reading at the beginning of the year, the odometer reading at the end of the year, and during the year, keep the track of all the trips that you had to your clients for business purposes separately from the personal purposes. You also can use different apps to track it. QuickBooks has a pretty good app for tracking your mileage. TripLog, you can also use a spreadsheet. It's important to mention that if you have a business and you are driving to the first business of the day from your home, it might not be deductible on your taxes as a business mileage. You cannot deduct commuting miles. And when you go to and from home, those are commuting miles. Anything in between is considered to be a deductible expense if you have your own business. All right, I think this is it for today. We're going to have other presentations, and you will be welcome to reach out and have any questions, if you have any questions. So next, we're going to have Q&A. We'll show the contact information, and you will receive the slides for this presentation. And now I'm going to transfer the floor to George.
Uh, Thank you, Galina. I love the
Mhm.
presentation, and we do have a lot of questions, and we'll try and get through as many as we can.
Sure.
The first one that came very, very early in the presentation was, what's the best way to organize your receipts?
There are a couple of ways in which you can organize your receipts. If you have QuickBooks or other accounts and software, you can attach them. There are apps that allow you to take a picture from your phone, including QuickBooks. You can just take a picture on your phone of the receipt and upload it into your QuickBooks. If you're using other software, the same thing. Many of them have the ability of you to taking a picture and attaching it to the expense. I hope it's helpful.
Uh, What's the retention period for record keeping and bookkeeping?
It really depends. To be safe, I would say to you 7 years. For the tax purposes, 7 years. But again, it depends on your business structure. It depends on the type of the audit that you have. Sometimes the IRS might ask you for the records even prior to the 7 years, but to be safe, 7 years is the number.
Okay. We have two questions that are quite similar. One is, I run a single member LLC. Is it okay if I don't take salary from my company for 1 year? And what's the impact? And the other question is, how would you pay yourself in an LLC as a single member and have no employees?
Okay, so as a single member LLC, you cannot take the salary for yourself as an owner. If you make an election to be treated as an S corporation for the tax purposes, then you will be able to, and you actually will have to take the salary to yourself. If you're a single member LLC, you can't. You can pay other employees in your business, but not to yourself. That was the first question about single member LLC, the salary, and how to pay, right? That was the second question. When you're a single member LLC, you take distributions from your business. So let's say you make $100,000 and with $60,000 expenses, and you have left $40,000. Even if you don't pull out this money out of your business, it's still your income for the tax purposes.
Yeah.
Does that answer the question?
Thank you.
Mhm.
Another question, which you'll have to interpret, it's a little bit cryptic, employees and expenses. And I think that refers to when you're determining expenses in your ratios, where do you count employee salaries and things like that? That would be my guess.
Okay, yeah. So it really depends on your business. As I mentioned previously, if, for example, you sell the product and you have the product that you sell, you have the selling price, and you have the product cost, what it costs you to get this product, that is your cost of goods sold. And all the salaries of the employees that you have in a business generally would be other administrative expenses. I wonder if I should go back to the slides or if we can just kind of like talk through it. If you have a manufacturing business, and let's say you are making something, you're making clocks, right? So you get all the details, all the parts for the clock, and then you have a person who assembles the clock in order for you to sell the clock. The salary of that person might be included in cost of goods sold versus being an administrative expense. If you have this employee who puts together the clock that you sell, but at the same time, you have a salesperson who works for you, the salesperson's salary is an administrative expense. It's not part of the cost of goods sold. I hope that answers your question.
This is a little bit of a repeat. I think you answered it, but let me just, if there's anything you need to add, please do. Did you say an LLC cannot pay members 1099 income to pay them for their billable hours on a contract?
I don't think that I said that. So there is a very distinct difference between salaried employees and 1099 employees or contractors. You have to be very careful about how you pay your employees or contractors. So essentially, if you tell your employees how to work, when to work, what tools to use, or you give them the tools to perform their job, they're your employees and they have to be on a salary. If this is, if you want to build a house and you invite a contractor, or if you want to build an office, you invite a contractor, you don't tell them how to do their job, you just tell them what needs to get done, like a build a house, then they're an independent contractor because you don't give them the tools, you don't give them the directions, you don't tell them when and how to do their job. I hope it answers the question.
We have 3 questions that are quite similar, and I'll, lump them together. They're from Everett, Kim, and Solveig. The first question is there a computer program a sole proprietor can easily use to track the 3 categories of numbers? I assume that's assets, liabilities. Okay. Then the Kim asks, can a small business owner use Excel for all record keeping and to create the statements you mentioned, or do we need to pay for an accounting software? And the third question was for bookkeeping, is it enough to use a detailed spreadsheet, or do you need a special accounting application? If so, what accounting applications are good for small business? Which I know you had a slide on, but the 3 questions kind of dovetail together.
Yes, yes. So you can use any tools that are convenient for you and dependent on the size of your business. If you are just starting out, or let's say if you have a side hustle, this is not really a full-on business, you can use Excel spreadsheet. Very important, always have a separate bank account for your business. If let's say you have a W-2 job, and in addition to that, you have a side hustle and you do something, I don't know, sell something online, let's say, have all the income and expenses for that separate business going into a separate bank account. That will make it much easier for you to keep track of your income and expenses. And if you want to do it on Excel spreadsheet, absolutely, you're welcome to do it. The accounting tools, like the ones that I mentioned earlier, like QuickBooks, Fresh, Wave, there's actually one that wasn't on my screen that is called 17 Hats that I've heard my clients using. And I've seen the reports. For small businesses that are just started, sometimes that could be a good option, depending on how much you're willing to pay for the software. So Xero, QuickBooks are going to be a little bit more expensive. As I mentioned, the program called Wave is less expensive. But if you have, let's say, a lot of inventory, the less expensive options might not work for you because you do need to track your inventory. Majority of my clients, I would say 90% of my clients call QuickBooks for the record keeping. Few of them Wave, FreshBooks, some of them spreadsheets, and one more, the 17 hats that I mentioned.
All right, thank you. This is a fairly broad question in terms of the answer, but Karen asks, we talked about cost of goods sold and the like, that's my addition. The question is, what if it is a service and not an actual tangible product?
Okay, so if this is a service, sometimes you might have the cost of goods sold. I was just talking actually to somebody about it, and now I'm kind of freezing on this. You can have some of the cost of goods sold expenses, even if you provide a service, if to provide that service, you need certain items that are not the general and administrative expenses. So if you would give me an example of your particular business, maybe, I would be able to formulate it a little bit better.
We have a couple of questions that really are asking for recommendations for record keeping receipts, and that question is phrased in several different ways. I know you had a series of questions and you talked to it a bit, but would you like to address that just as a general concept? Is there one recommended or one or two recommended ones that you would suggest, or is it see what works best for you?
It's what works best for you, to be honest. I had some of the programs that worked for me beautifully, but then for other clients, they didn't. They hated them. They would always lose the receipts, right? If you make most of the purchases online, you can just create a folder on your computer where you download all your receipts or invoices, right? And if you make purchases on the go, then the apps will take a picture of it, and usually you can find it in your app store just by Googling it. There are many of them that are free if you upload only a certain amount of receipts. And if you have many receipts, then you would have to pay some monthly fee or per receipt. But usually any app that works for you personally.
Okay. There are one or two questions here or requests here. Can I make an appointment to discuss an item or two? I think we've covered that a little bit. Galina's contact information is in the slides that you'll be getting probably tomorrow, worst case the day after. And SCORE's contact information is there. And I would recommend that you send a quick email to Galina and ask that same question. We do have a question for an interesting one. Brooke asks, I occasionally buy items on Facebook Marketplace for my business. With this way of shopping, receipts are not given. What should I do?
That is a very good question. It is a very interesting question. I haven't gotten any clients with that type of question, with that type of purchasing yet. But if you make a screenshot of the conversation on the marketplace, right, about the purchase, as long as you have something in that conversation that confirms that you met and that the item was transferred and you actually purchased something, I would keep that. There is not much that you can do otherwise.
There might be a receipt you might have paid by check or through PayPal or some vehicle like that,
yeah,
which might be able to be used as a record, especially if, for example, in a check you put down what it was for on the face of the check. But that's just a thought.
Right.
How do you know if you should pay taxes quarterly?
How do you know if you should pay taxes quarterly? If your tax liability was $1,000 or more last year, then you need to pay the taxes quarterly. Usually, it's the best practice to put aside, especially if you're just starting, around 25 to 30% and pay that as a quarterly payments. And then at the end of the year, if you overpaid, then this money will come back to you. Because what is the tax return at the end of the year? It's pretty much a reconciliation to make sure that what you owe to the IRS or local authorities is paid. And if you overpaid during the year, then they give you the money back. But I find that it's always is better to put aside a little bit more. Yes, the IRS kind of uses your money interest-free. They actually started paying interest on the refunds that they haven't paid out. But it's always is better not to have the tax liability and huge tax bill at the end of the year. So there are certain due dates that you need to know to pay your taxes on time. We're talking mostly about bookkeeping today. So this is a little bit outside of the topic, but you can Google it, or, well, when you Google it, go to the IRS website in particular to find the dates.
Okay. Is it a good idea to work with a bank that provides bookkeeping, record keeping, taxes, and deductions for solopreneurs? This person recently signed up with Found banking services that provides these free accounting services.
Whenever you're not paying for service, then that means that you're a service. That's, something that somebody said to me some time ago that I really liked. I mean, yes, why not? If you are small enough that you don't need to have some complicated cases to be discussed with your bookkeeper or an accountant, you can use the free services as long as you get out of it what you need. And what you need is the clear financial statements and a clear records of all your income and deductions, your inventory, if you have inventory, and again, depending on your business structure, and the receipts.
Along those similar lines to the quarterly tax returns, what months would be considered quarterly for small business LLC? Also, do you just send the money in? Also, how do you know what you owe?
All right, there are a couple of questions that we need to answer. You know what I'm going to do right now? So the quarters do not run like the calendar quarters. Let me look up, because of course I don't remember all the deadlines. All right, so the quarters, here is the IRS website. And of course I wouldn't be able to find it right now, but okay, I'm just going to tell you. So for every 3 months, you have to pay estimated tax payments. I believe that IRS considers June and July, or July and August, like one of the quarters. So, and then the rest, September, October, November, December as the next quarter. I believe that's what it is. I would need to look it up. I apologize. I can't really talk, from the top of my head. But the due date for the first quarter is usually January 15th, which already passed. I believe that the next one is March 15th, or part of December, January, and February, if I could remember. Again, I'm sorry, I can't remember right now, right? So you can look it up on the IRS website. How do you pay? For the IRS, you just go to their website, pay estimated tax payments, and you input your EIN or your Social Security, depending on what you're working with. You don't even have to even log in. They have the option of you paying the tax as a guest. You will input your Social Security number. You will input the reason why you're paying. You will indicate that this is estimated tax payments and what year this is for. On your local authorities, I'm going to talk about New York right now. Each site has different procedure. On New York, in New York, you also go to the IRS website. I'm sorry, not IRS, the New York State Tax Authority website. And the same thing, you can pay the tax, I believe, also without the login in. Another option is that you can mail in a check with the Form 1040-ES, estimated tax. I don't recommend mailing anything in because IRSs and the local authorities are known for being very, very busy and not replying to mail on time. So online options are the best options. And how do you know how much you pay? It really depends on what is the type of your business and how much income you have in your other everyday activities. If you are married, you might have your wife or husband who works, right? So the calculation might be a little bit different. The IRS website has the tax estimator that you can use to estimate your tax payments. But the rule of thumb is usually put aside 30%. If you have to pay less, you'll pay less. I hope it's helpful.
Galina, I'm looking at my watch. We have about a minute left. There are a bunch of questions about mileage. would you go over them again just very quickly? And I'll repeat that for those of you whose questions we have not gotten to, and there are quite a few, I'd ask you, could you please just send a quick email or text to Galina. Her information is included in the packet that you receive, and she'd be happy to answer those questions. And as I say, we have 60 minutes and we're at about 59 minutes at this point in time. Galina, just very, very quickly, just one part of the mileage question. Can I deduct mileage from my house to a client?
From your house to the first client of the day, the general rule is no, because that is considered to be the commuting mile. If you travel from one client to the next client, then yes, you can deduct those mileages. Please talk to your tax accountant. In some cases, you might be able to, but right now I can't, go into that in details.
Galina, thank you so very much. Would you flip to the next slide for me? That was a
Absolutely.
wonderful presentation and great Q&As.
Oh, sorry.
Sorry, we didn't have a chance to get to all of them. There were about 80 questions that came through, and I suspect that there are probably another more en route. But again, thank you very much. I just throw in a quick commercial. Our next month's webinar, which is going to be in mid-February on the 15th at 1 p.m., raise your fees, or how to raise your fees without losing your clients, which is also a very important question. And we love to see you in a month. Meanwhile, stay warm this winter. Galina, thank you so very much for a really informative and great presentation. And thank you all for joining us. Have a great day.
Thank you. Thank you for having me today. And please reach out if you have any questions. Thanks.